Gold is crashing. Silver is crashing. And despite what the headlines, influencers, and precious metal hype channels are telling you, this move is not finished. If you own gold or silver, this video might make you uncomfortable. If you're waiting to buy, it might save you a lot of money. And if you think this is just manipulation or just a temporary dip, you're going to want to watch this entire video. Because today, we're going deep. Not surface-level explanations, not emotional reactions, not clickbait fear. We're going to break down why gold and silver are falling, why this crash is very real, why it's probably not over yet, what the big money is actually doing, what comes next, worst case and best case, and most importantly, how to position yourself intelligently. This is not financial advice. This is macro reality. Let's start with the big picture. Gold and silver didn't just drift lower, they broke down. Gold lost key support levels that had held for months. Silver, as usual, got hit harder, faster, and more violently. This wasn't random. This wasn't just a bad day. This wasn't a tiny correction. This was a structural move. Let's talk about what the charts are actually telling us. Gold failed to hold previous highs. Lower highs started forming. Support zones gave way. Momentum indicators rolled over. Silver lost psychological levels, broke trend lines aggressively. Volumes spiked on the downside. Classic risk-off behavior. These are not bullish technicals. Now, pause here. This doesn't mean gold and silver are dead. It means we entered a different phase. And to understand that phase, we need to zoom out. There's a belief that gold and silver always go up when inflation is high, debt is rising, governments are reckless, money printing exists. That belief is dangerously incomplete. Gold and silver don't move on inflation alone. They move on real interest rates, liquidity, and fear timing. Let me say that again. Gold doesn't move when inflation is high. Gold moves when real yields fall and liquidity expands. And right now, that's not happening. This is where most retail investors lose the plot. Gold hates positive real yields. If rates are high, inflation is falling, the dollar is strong, then gold struggles. Right now, central banks are talking tough. Rates are staying higher for longer. Inflation is cooling, not gone, but cooling. Cash finally pays something. So what happens? Capital flows out of non-yielding assets and into cash, short-term bonds, dollar-denominated assets. Gold and silver? They don't yield anything, so money leaves. That's not manipulation, that's math. Every gold and silver crash has a common enemy, the US dollar. When the dollar strengthens, commodities fall, precious metals fall, emerging markets suffer. And lately, the dollar has been resilient, even with massive debt, political chaos, deficits exploding. Why? Because in a messy world, the dollar is still the cleanest shirt in the laundry pile, the deepest market, the global reserve. As long as the dollar stays strong, gold and silver stay under pressure. If you learn one thing from this video, let it be this. Gold follows liquidity, not headlines. Right now, global liquidity is tight, fragmented, draining in places that matter. Quantitative tightening is real. Bond issuance is massive. Governments are absorbing capital. When liquidity contracts, everything speculative suffers. Yes, even safe havens. Gold is not a hedge against tight money. Gold is a hedge against monetary panic. We are not there yet. Silver is not just cheap gold. Silver is industrial, volatile, thinly traded, speculative. When growth expectations weaken, manufacturing slows, risk appetite fades, silver collapses faster than gold. That's why silver crashes harder. That's why silver bleeds longer. And that's why silver lies to people at turning points. Silver doesn't lead recoveries, it confirms them, late. Yes, they are. And no, it doesn't matter right now. Central bank gold buying is slow, strategic, long-term, price-insensitive. Markets trade on marginal buyers, speculators, funds, liquidity flows. Central banks don't stop crashes. They absorb supply over time. Bullish long-term? Absolutely. Bullish short-term? Not necessarily. In 2008, gold initially crashed. Silver got annihilated. Liquidity vanished. Then, after, central banks panicked. Money printing exploded. Gold went parabolic. History rhymes. The crash comes first. The bailout comes later. The bull market comes last. We are somewhere between phase 1 and 2. Scenario 1. Slow bleed, most likely. Gold drifts lower. Silver stays weak. Dollar stays firm. Frustration builds. Scenario 2. Sharp washout. Sudden liquidation. Panic selling. Headlines turn extremely bearish. Best long-term buying opportunity. Scenario 3. Immediate reversal. Least likely. Liquidity flood. Emergency cuts. Crisis event. Prepare for 1 or 2. Don't bet blindly on 3. Smart money. Scales, not YOLOs. Waits for confirmation. Buys weakness after capitulation. Watches real yields and liquidity. They don't marry narratives, they marry timing. The gold and silver crash is real, and it's probably not over. That doesn't make gold useless. That makes patience priceless. If you understand cycles, if you respect liquidity, if you detach from emotion, this crash won't hurt you, it will prepare you. If this video helped you see the bigger picture, hit like, subscribe, and let me know in the comments. Are you buying this dip or waiting for blood in the streets? Stay sharp, stay patient, and I'll see you in the next one.